Gold prices declined to start out the week, taking prices down about $40 at one point, all the way down to 1917, ending the session just north of 1920. Taking a step back, if you look at that range since after FOMC, since we closed on March 16th, we've traded in around a 1910 to 1966 range. So we gave back almost that entire move that we saw post FOMC in one day today. The dollar very strong. And likewise, short end treasury yields were moving higher. Cryptocurrencies were also moving higher as well, sort of a risk on trade there. But clearly, a lot of the geopolitical tensions that have been on the rise have come off. We still have a lot of uncertainty when it comes to what the central banks are doing around the globe, as well as economic data and whether or not we're going to see a recession here. Treasury yield curves are suggesting a recession is coming, excuse me. But right now, that defensive gold play seems to be off the table as gold prices decline again, about $35 from Friday's settlement, getting as low as 1917 today. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice that volatility has been moving in tandem with prices. So as prices have risen over the last couple of weeks, we've seen volatility nudging higher. And then today with this big sell-off, we saw volatility moving lower. So ultimately, it remains very price tied, at least for the moment. That hasn't been the way it's always been, but we've seen it go back and forth. And right now we are currently in that price sharing, volatility sharing trend. Volatility going lower today as prices move lower, but remaining in that year-to-date range. We didn't see a breakout move. We are just now getting to the lows that we saw nearing the post-FOMC lows. Lastly, let's talk about positioning. What were those speculators doing after FOMC? The last CFTC report that came out only gave us data that led up prior to the FOMC meeting. So what did they do? As prices, we've seen prices after FOMC moving higher, we suspected that speculators would have been net buyers and adding to their long positions, but we were wrong. Right now, looking back at those numbers, speculators were exiting their longs after FOMC. Doesn't mean they weren't buyers after last Tuesday, but ultimately the knee-jerk reaction that we saw after FOMC, where prices were moving higher, speculators were exiting during that rally. Their net position shifted lower to net their longs lower. So ultimately, not what we thought initially, and that's why we look back at the data to get confirmation. Speculators who are typically good indicators of directionality and momentum were not in this case, because prices did move higher, despite the fact that speculators were exiting their long positions. So starting out the week, gold prices seeing a big move lower down to about 1917 before ending the day around 1920, giving back almost the entire move that we saw since the post-FOMC trade.